So, it's a high privilege for me to being here and give a presentation, and it's an excellent situation that I have to give after lunch a presentation about accounting and actuarial smoothing in retirement payout life annuities, participating life annuities. So, this is a work which I have written together with Olivia and Ralf Rogalla and Yvonne Sieglin. Yvonne Sieglin, she is a trained actuary, so it was only possible to do this kind of research with somebody who is really interested to go in deep in numbers and all of this stuff. It's an attempt to try to quantify, not only to talk about, but to quantify the effects of accounting standards and actuarial techniques for a special kind of an annuity product. So, oops, not working. Now, here we go. Okay, a little bit of motivation. Life insurance companies, we know that they love to smooth their profits, over time. They do this with two different, let's call it techniques or rules. So on the one side, they use the techniques from accounting or the rules from accounting. Nobody understands that. When I was here in the US, I spent a year here at the Wharton School, and then I had time, and really I tried for about 2 months to understand accounting. And I had a big book, 100,000 pages, I think, and I really read this book. And every day I drove home with Olivia in the car, and after 2 months, after trying to explain her all of the things, she really told to me, Raimund, you are talking strange. And then I stopped that, and I think, okay, now I don't go in more deep in the accounting rules, let's try to quantify the things. So the most important two components are the so-called historical cost evaluation of assets, or the market-to-market, or the so-called fair market evaluation of assets. That's one part. The other part is accounting, actuarial techniques. So actuaries like to build reserves. They really love to build reserves. So they build it, and sometimes they draw it down, and with these kind of reserves, they try to smooth again the profits of a life insurance company. That's highly criticized, this smoothing. It's non-transparent, nobody understands. It's hard to assess the insurer's real risk status. So this is coming from the insurance literature. Smoothing being criticized to be an illusion. So one of my colleagues here on this panel said this also. There's no value for policyholder, huge critics. And if you're looking then in the accounting literature, which is really also an interesting literature, if you're not prepared on that, that's also a hard thing, then you see a lot of discussion about fair market value or historical cost value. What to do? This is really two groups. The people who love fair market value say this is a better risk assessment of the company. So especially if you report with a balance sheet to the public, especially if this is traded on the stock exchange, that's the right way to inform investors who want to invest in the company. Others say this is completely misleading, and then there is a big discussion about that with no solution. We study here in this paper and we try to quantify the utility impact on policyholders of life insurance, of annuity products, and on the profitability of the insurance company offering these kind of products. We do this with a special product. It's a so-called participating life annuity. So, okay, let's talk first a bit about a participating life annuity. So life annuities, payout annuities, they want to pay on a regular basis lifelong benefits to the annuitant. And the annuity benefit depends on actuarial assumption and on the kind of risk-sharing agreement or an arrangement between the annuitant and the annuity provider. Risk sharing means we have to look about risk categories, and the most important are investment and interest rate risk. Yeah? So you don't know the development of the assets where you invest all of the premiums of the annuitant. You don't know the development of the interest rate risk. Nobody knows, or nobody would have known that we now have something like 0% interest rate risk around the world, especially in the European community. You have the systematic and the individual longevity risk. So basically, annuity products are pool products. You create a pool, then people die. This is an individual mortality risk based on an assumption on the mortality table. People die. And then you have also the possibility that the mortality table itself will change over time. It's a mortality improvement. And this is a very hard risk to calculate. That's a systematic longevity risk. And of course, you have the default risk of the annuity provider. Basically, if you have a look to the annuity market, you have three kinds of annuities. It's the standard annuity, the fixed annuity, where the annuity provider pays a guaranteed lifelong, in most of the countries, as here in the US, a nominal benefit for the rest of the life to the annuitant. Of course, in this situation, the annuity provider has all of the investment risk, have the longevity risk, but the annuitant have, of course, the default risk of the annuity provider. That's possible. Then you have the variable annuity. The variable annuity linked the benefit to a specific asset portfolio. So the annuitant decides what kind of asset portfolio he likes, maybe a stock fund or balanced fund, and then the value or the amount of the benefits depend exactly on this chosen asset portfolio. That's a variable annuity. We have many of these variable annuities here also in the US. I'm talking about now on the participating life annuity. So the participating life annuity linked the benefit to the overall, let's call it to the collective experience of the annuity provider on mortality and investment. Yeah, so there is a big pool, and the annuity provider gives benefit depending on his overall experience on that. That's a very attractive possibility to handle systematic longevity risk and also the complicated interest rate risk. In the situation where you do not promise too much, yeah, and then you see how it's working with the mortality experience, then you can provide the annuitant with higher or lower benefits. In the US, you have such a kind of a participating life annuity. There is one big annuity provider, which is TAA-CREF, the so-called traditional annuity, which is close to that, what I'm doing here. And in the European market, in the German market, in the North European market, this is a kind of a standard product, this participating life annuity. So how is this working, this participating life annuity? Oops, that's the other direction. So the way how it works is as following. So the benefit of the participating life annuity have two parts. It's a guaranteed benefit, which is guaranteed lifelong benefit for the rest of the life, plus an additional surplus. And this is due to a profit-sharing arrangement between the annuitant and the life insurance company. The guaranteed benefit typically is calculated using conservative actuarial assumptions on interest rate and mortality. So let's assume you have a situation in the capital market where you have an interest rate of 4%, then they calculate the guaranteed benefit maybe by using an interest rate of only 3% or 2% or 0%. With a mortality table, they use mortality tables with a high risk charge. So the guaranteed benefit is calculated on relative conservative actuarial assumption, meaning that for given premium, the guaranteed benefit is low, or if you have a high guarantee, the premium is high. But then the system works as follows. Then the insurance company observes every year his experience on mortality. And then let's say you have a situation where more people are dying compared to your actual assumption, then there is a kind of a a profit, and you share this profit with the annuitant. Also with the capital market, if you have a higher asset return compared to what it was assumed, you share it with the annuitant. This profit sharing rule has different components. First, you have to really write down how to measure and to report surplus. That's not easy. It should be not only to the discrete choice of the CEO, you should really write down how to measure and report surplus. And for that, you need, at the end of the day, you need something like a balance sheet or accounting measures, because these are numbers which are certified, which are checked, and you can use that. Here plays the accounting category comes into the game. Then you need a profit sharing rule between annuitants and shareholders, the shareholder of the company. Here I assume 90% of the surplus is going to the annuitant, 10% is going to the shareholder. And then also you need, which is also very important, you need some profit sharing between different product lines. You know, such an insurance company starts to sell products 10 years ago, then you have new products, and there should be not too many cross-subsidies between the different product lines. This has also to be written down. And then you have to also write down how to allocate a surplus after you measure that to the annuitants. Yeah? When really you pay it out to the annuitants. This also, everything has to really document it in a profit sharing mechanism. So let's have an idea a little bit in terms of numbers. So let's say what I'm used here, you have a guaranteed benefit. Let's assume here it is $10,000 for the rest of your life. That's a guaranteed benefit. Assume that you have an actuarial factor which based on a guaranteed interest rate of 3%, which is today not safe, but in the time when I started this study, it was higher, the interest rate. So for a moment, assume 3%. And use an US annuity table with a lot of risk charges. Then you have an actual factor of 16.3%. Overall, you have a premium what you have to pay for the 10,000 for the rest of your life of close to 160,000. Yeah? Then the overall benefit depends on part number one, the guaranteed benefit, plus the surplus. The surplus is a function of the asset surplus and the mortality surplus. The asset surplus, here the accounting measures, the accounting rules are coming into the situation. And F, yeah, this is then, if you have an asset surplus, if you have a mortality surplus, then you have the accounting, the actuarial smoothing. The mortality surplus is relatively easy. You have to observe the pool of your annuitants and compare this to the assumption in your mortality table. Yeah? This is relatively easy. How it's going on now with the asset surplus, which is more complicated. So, the asset surplus is the fund invested. You have to define that. And then it's the asset return minus the guaranteed interest rate. So, that's the difference of the reported asset returns and the guaranteed interest rate. In my example, all of my calculation, it's exactly 3%. Now we have a little bit of kind of formulas, yeah? Not only here, yeah? So the reported return depend, of course, on the asset allocation. That's a decision how much you invest in stocks, how much you invest in bonds, and the asset valuation method. And here I look to two different asset valuation methods, the historical cost value approach or the market-to-market or fair market value approach, only to these two things. In real life, there is some choice. Yeah? Companies can have some choice where to put the assets. Some assets you can put due to an historical cost value approach, the other you can put it to a fair market value approach. In the paper, we discuss also about this, what is then an optimal choice, yeah? But here I look only for these two different possibilities. If you have now a fair market value approach, then on the left-hand side, you see the return of your stock investment. N is the number of stocks what you have in your portfolio. On this number of stocks, you get dividends. Yeah, this is cash. There is no evaluation question. Get it in your cash account. That's easy. But then you have the difference between the stock value of today, this is ST, minus the stock value a year before. Yeah? And in the fair market value approach, you use exactly this difference to calculate the return. And in this situation, you use unrealized capital gains and losses. It's not that you sell them. In the situation where you have an historical cost value approach, you realize these gains, you measure these gains only if you realize them. So it's necessary that you have to sell a certain number of stocks, and then you compare the selling price compared to the price where you purchased that. Yeah? And this is the difference between these two situations. And the same is for bonds, and the same is also for the same is for bonds. So that's the accounting method. The actuarial smoothing is, the idea is if you have measured an asset return and a mortality surplus, then you smooth the payout over time by retaining some surplus in good years, building up a buffer fund, they name it the so-called contingency reserve, and you draw down the contingency return to maintain the surplus, the payouts in bad years. That's the general idea. The technique is a kind of a mathematical art. If you are interested in that, you have to read my paper. The idea of that is the level of the payout should be sustainable. So you have a look on the level of the buffer fund, you have the last year's surplus, and then you are looking to something like the risk or the probability to change the next year's surplus soon. Yeah? So you don't like to have a surplus and the next year thereafter you have to change it again. So this is a kind of a mathematical art. If you are interested at least in the technique, you have to look to the paper. So what we have done in the next step is we build up now a realistic life insurance company. We study how this is working, had a look to the balance sheet, and I worked together with Yvonne Sieglin. She is an actuary, so we are really able to bring all of these things. And what we have done, we are looking to a life insurance company in a run-off scenario. We have 10,000 men, age 65, and we have a run-off scenario, have solvency restriction, all of these detailed. And we are looking to this participating. The pricing is with an interest rate of 3%, use the US mortality table, build an asset model for the bond part, for the interest rate part, for the stock part, calibrate that. We have an individual Markov chain for the pool of annuitants, build a Cairns-Blake and Dowd model for the change of the mortality table, and so on and so on. Then we run the model, and then we had a look what are the outcomes depending on all of these rules to the annuitant, and what is this is then the annuitant perspective, and then on the other side it is the insurance perspective. After the runoff scenarios at the end, we had a look to the internal, on the distribution of the internal rate of return for the insurance company. And here are some results. So what you see here is a situation where I use only accounting smoothing. What you see here is the following. This is the utility of the annuitant, and we measure that annuity in such a way, and we ask the question, what is the level of a fixed nominal payout annuity which provides the same utility as the participating life annuity? So in this situation, we see the following. In a situation where you make a fair market evaluation, and if you invest 60% of your assets into bonds and the rest into stocks, then you get a utility which is equivalent to 11,500 of a nominal payout life annuity. So, put it another way, if you have no access to this participating life annuity, you have to offer this individual a standard fixed life annuity with a guaranteed benefit of 11,500. Yeah? And think about, in the participating life annuity, guaranteed benefit was only 10,000 plus the surplus. So this is an increase of 15%, which is something. Yeah? If you run now this situation, if you really put this number of a lifelong nominal life annuity into the model, then you will find out that there is a high danger of the insurance company to become insolvent. Yeah? So this is it's a huge increase in benefit. So it adds value, this life annuity, this participating life annuity. Then we run now the complete model by evaluating the asset not due to fair market value, but to historical cost evaluation. Yeah? We only report and use the surplus for the profit sharing mechanism if it is realized. And then we find out that there is an enormous increase for all asset allocation compared to a situation where you have a fair market valuation. Yeah? Then you add value of another close to 9% in utility from the perspective of the annuitant. What's the reason behind that? The reason behind that is that we are at the moment in the payout phase. So individuals like relative stable returns in the payout phase, but not 100% stable. Not 100% stable, which is offered by the fixed life annuity, which is exactly the same number until the rest of their life. They accept a kind of variation, but this should be smoothed. And this is exactly what the participating life annuity with all of this smoothing technique is doing. So there is really an increase in utility if you do these things in the decumulation phase. Now we combine it. We have the accounting smoothing and the actual smoothing. Yeah, then also you find out that there is an increase compared to a fixed life annuity, but the picture is not as clear. Yeah? There could be some over-smoothing. Yeah? If you have certain asset allocation and you smooth on the accounting side and you smooth also on from the actual side, then maybe sometimes the fair market value is better on the other side, or sometimes the historical cost value approach is better. So from the annuitant perspective, it's not really 100% clear if the actual smoothing technique plus the accounting smoothing technique really adds value in all of the situation. Now if you're looking to the insurance profitability, so we run the complete simulation model, we had a look to what the insurance company has to pay into the system in terms of solvency capital, what the insurance company can take out in terms of dividends, or at the end, when all of the people are dead, what they can take out in terms of remaining wealth, and calculate the internal rate of return. And here you see also the expected internal rate of return. What you see here again, you have the two lines. The dotted line is with fair market value, and the solid line is with historical cost value approach. Then in all of the situation, the profitability for the insurance company is better if you make an evaluation due to historical cost value. Yeah? It's clearly better, and a situation where you have guaranteed returns of 3% and run everything with market value, basically in 20 to 30% of the situation, the insurance company is, by the way, insolvent, and this is also the reason why you have negative expected internal rate of returns. So then we have a situation where both these accounting techniques for this special situation adds value to the utility of the annuitant, plus to the profitability of the insurance company. Again, if you make accounting and actuarial smoothing, so this is what insurance companies like. Yeah? So if the insurance company have both accounting and actuarial smoothing, this increases a little bit the profitability compared to a situation where you have only accounting smoothing. Okay, some conclusions. I told you it's not easy, yeah, but this is what's coming out. These participating life annuity are, in my perspective, quite attractive risk-sharing mechanism to give retirees, on the one side, guaranteed benefits if they are not too high. Now, you should avoid to give too high benefits while handling systematic mortality risk and capital market risk, long-term capital market risk, which are the complicated risk. And by the way, it sometimes impressed me how an how an insurance company can calculate something like a value at risk of 99.5%. Yeah? So I calculate like crazy with that, but the estimation error is, much more than 99.5%. Yeah? So it's really hard. Our model permits to study the implication, the utility and the profitability implication of smoothing. Yeah, we can shut it on, we can shut it down, turn it on, shut it down. And we also see that these accounting actuarial rules for smoothing strongly influence benefits. So smoothing is not an illusion, it has impact, and it could have, in this special situation, also positive impacts. Maybe some statement for further discussing. Pushing insurance companies more toward this fair market value approach may reduce both annuitant welfare and the insurance profitability and stability. So really one have to think over, if you go to such an approach, it's not always the right way to do. This maybe helps, this kind of study helps to quantify the things what you are doing. Thanks a lot.